Equity Access. My name is Sandra, and here with me is Eben Mabunda. Welcome, Eben. How are you doing tonight?
Well, can't want to complain. Should only get better yourself.
I'm all right, thank you. So what stories do you have for us tonight?
We've got several developments to look into, Sandra. For starters, government has been urged to be cautious when mortgaging mineral resources for development. This was highlighted by private sector leaders at the Zimbabwe High-Level Debt Conference held in the capital recently. The event themed Public Finance Management in Zimbabwe, Gaining Traction or Destruction, was attended by various stakeholders in the economy courtesy of the Zimbabwe Coalition on Debt and Development. This comes against the background of government securitizing foreign debts with local minerals. 3 weeks back, Central Bank Governor Dr. John Mangunjika was quizzed by the Parliamentary Committee on Public Accounts as to the securitization of foreign debts against local minerals. Speaking at the Zimbabwe High-Level Debt Conference, former Zimbabwe Investment Authority chairperson as well as veteran banker and entrepreneur Dr. Nigel Chanakira highlighted the need for debt containment as well as constructive borrowing. Let's take a listen.
I'm a market player, so it was very difficult, to work within the civil society movement. But I could understand. We have a nation that is carrying a huge debt, and we are conflicted because the financial markets won't like the signals that we're sending to them. But then how do we come to resolving this issue as parliamentarians? I think as parliamentarians, we've got to step up to the plate and come up with sustainable solutions for our economy. Because anything short of that, we fudged it in the past. I think we're trying to fudge it again in a way, and I think fudgeability doesn't work. So I like what's coming out now of Ministry of Finance in the sense that it's a balanced budget. We are no longer issuing treasury bills, and hopefully we'll get to that Lima closure in terms of an agreement and then offer some relief to the market. But I would argue that never again. That's the legislation I would be calling for. We've played this game once, twice, 3 times. I did my research in 1990 on public debt. That limit was at 20, it was moved to 30, we're back at 20. But if we violate it again, we're back. So we violated it in the 90s. We saw hyperinflation all the way to 2008. And then we get back again to 2018, if we can draw the line there, and say we're back to where we were. And now we play another game again. I would say no more. And so as civil society, as Zimbabweans, and as parliamentarians, I think we will give you the teeth that you need to say no more. We want sustainable long-term savings. We want debts that are performing nationally in as much as we ask the private sector to also perform on private sector debt. Thank you.
Well, even we hear fuel prices in South Africa have gone up. Like, how did that come about? Can you take us through that?
Yeah, correct, Sandy. South Africa fuel price is set to increase 9%. That's with the effect from the 3rd of April, which actually means 2 days from now. For more detail, we're just going to have a listen to a South African expert giving us the details as to how is this actually coming into play. So let's have a look.
So the Automobile Association releases 2 press releases a month specifically on the petrol price, where we have a look at what the data is from the Central Energy Fund, and based on that we make a prediction of how we think the petrol price is going to go at the end of every month. So we release a statement in the middle of the month, and then we release another one at the end of the month, shortly before the Department of Energy actually makes the announcement and makes it official. And basically what we said in the release that we issued on Friday for the outlook for June was that petrol was going to go up by around 52 cents a litre, and diesel would go up by 76 cents a litre. And we noted that the 2 major factors that are contributing to this increase is one, an increase in international petroleum prices, in other words, international oil prices that are quite high, and two, the weakening rand US dollar exchange rate. And those two factors essentially are combining to give us the increases that we see today. So the Automobile Association releases two press releases a month, specifically on the petrol price, where
why is that important to Zimbabwe? Well, if in case you don't know, when South Africa coughs, Zimbabwe sneezes. Let me explain that to you. Now, South Africa happens to be Zimbabwe's largest trading partner. If you just have a quick look at the stats, over the past period, Zimbabwe exported 79% of its produce to South Africa, while importing 41% from South Africa. Well, next to that, of course, would be Singapore, which is about 21% in that regard. But key there is the fact that South Africa is where we're actually getting most of our products. So when there are fuel price increases in South Africa, this means the cost of South Africa increases, the prices of their commodities also increases. Twinning that is a 9.4% increase with regards to the prices of electricity. So if South Africa is reeling from electricity as well as fuel prices, then well, if Zimbabwe is importing as much as 41% of its imports from South Africa, then we definitely get to feel the pain. Let's get into as well the details of the fuel of the price of fuel in South Africa, just to give you perhaps an appreciation of what it is that the graph is actually coming from. January 2017, they're coming from a base of 13.9 cents. That's in rands, right? Then they get to 13 rand 54 in April of 2018, reaching an all-time high of 16 rand 85. That's October of 2018. The figures then actually come off to about 13 rand 79 in January of 2019. Then when we get to this April now, that's about 15.90. The stats figures are actually set to increase from that position to by a very good 9%. So when that comes into play, this actually spells out negatives for Zimbabwe. Now, when we have the prices of fuel actually playing in that space, well, of course that was petrol. This then becomes the diesel. Diesel is also following what seems to be a similar trajectory, where in January of 2017 coming from 11 rand 45, October 2017 that's 12 rand 19, April 2018 that's 12 rand 15, reaching an all-time high in October of 2018 of 16 rand 12. Then all over into April of 2019, that's 14 rand 87. And again, there has been a 9% increase, which is expected to actually come into effect on the 3rd. That's exactly 2 days from now. So if that matrix plays out in that direction, what could also be the net effect for Zimbabwe? I'll break it down for you. What this means is, as opposed to what our very own finance minister has indicated, that perhaps our inflation could subside. If things continue that pace, then definitely we are not going to see a decline in terms of our inflation. Mind you, we're talking about an inflation of about 59% recorded this month, coming from 56% in the previous month. Remember, we're coming from October, an inflation of 5%. So at that pace, and with things getting that bad in South Africa, I would be the one to be the pessimist against what the finance minister has actually said. Well, then perhaps moving on to our next story, CABS loses 19 million rand in Efis 9 readjustments. Well, according to the latest financial statements released by Old Mutual's 12 months period to December 2018, it reveals that Efis 9 was adopted as a replacement of IAS 39. Efis would be International Financial Reporting Standards. IAS would be International Accounting Standards 39, which brings with it changes to classification, measurement, as well as impairment of financial assets. The standards is more conservative and prudential in its classification of financial assets, as it recognizes and provides for potential losses earlier than the IAS 39. In essence, what that means is where the IAS 39 would allow for losses to be registered as actually made. Efis 9 says, no, anticipate losses and then account for them accordingly. So this is what has actually happened. So where KEBS was expecting to have accounted for certain losses at a certain point, according to the new accounting standards, it is now actually accounted for them prior, hence the 19 million US dollar loss in that regard. And according to the presentation of the financials presented there by the chief executive, he said, and I quote, as a consequence of the new standard, the group has revised its impairment methodology under Efis 9 for each of these classes of assets. The impact of the change in the impairment methodology on the company's total equity is disclosed in note 13. So that's about it from the KEBS story.
Interesting. So tell me something. I hear something about the Brainworks. What's
Correct.
going on with that?
Correct. Sandy, Brainworks is a JSE listed company with investments here in Zimbabwe, particularly African Sun as well as Dawn Properties. These two companies are listed on the Zimbabwe Stock Exchange. Well, basic story here is the financials were said to have been released as at this point in accordance with the stipulations of the Johannesburg Stock Exchange. But now, because of its assets which are domiciled in Zimbabwe, and factoring the fact that there have been monetary policy pronouncements by the Reserve Bank of Zimbabwe, as well as new guidance by the Public Accountants and Auditors Board, there has been a delay in the release of those results. However, we've been given a prelude as to what to expect in the results when they actually do come through on the 30th of this month. So just to give you perhaps a rundown of what has been presented therein, I'll just go through Africa Sun as well as Dawn Properties. Beg your pardon. Well, according to the report, for African Sun, the growth in hospitality revenue was achieved on the back of a 7 percentage points increase in occupancy levels to 59%, while the growth in occupancy levels was driven by strong performance from all source markets, with room nights sold for domestic, international and regional increased by 12%, 14% as well as 7% respectively. Of note as well to this particular factor is the fact that this is in line with a growth in revenue figures for Zimbabwe as far as tourism is concerned, because in 2018 Zimbabwe recorded for the first time ever $1 billion in forex receipts. So this of course would be in line with the performance of the tourism sector in its entirety. Then on to Dawn Properties, which is also listed concerning the Zimbabwe Stock Exchange. According to the report, property sales in the inaugural year saw income for the segment rising sharply ahead of the prior year. Brainworks said 70% of the growth was attributed to property sales. Well, they've been able to actually sell pieces of land, and this has actually contributed to a growth in terms of the revenue figures in that regard. Well, we're going to take a quick break, and then when we come back, we'll have a discussion on these and other concerns from Sandy and I for the segment. Donkey. Stay tuned. Joined in the studio by our resident chief analyst, Respect Gwenzi. Respect, good evening and welcome to the show.
Thank you, Eben. It's good to see you in shape. Good evening, viewers.
Fantastic, thank you. Well, let's cut to the chase. Let's start by talking about South Africa fuel prices. I mean, as I said earlier on, when South Africa coughs, Zimbabwe sneezes. What is the relevance of the increase in terms of the prices of fuel for South Africa with relation to Zimbabwe?
I think the context is mainly on the trade side. South Africa is our biggest trading partner, both in terms of our exports and our imports. Actually, on average, 40% of our imports are sourced from South Africa, and most of the basics are also sourced from that respective market. So obviously, when such changes come in, especially with given the magnitude of the change of between 8 and 10%, and there's been a rise in terms of that price for quite a number of months now. We could not share that there's been a consistent growth now in the second month, and I'm sure we're running again into another increase, and we're almost nearing the 2-year high, which is at 16.85. So I think that's a real concern, given that we rely on that market and our own fundamentals have not been okay. If you are to look at how the local unit, which has been partially liberalized, is trading at, against other currencies, notably the USD and in fact the Rand as well, you find that our currency has been weaker against those key currencies. And what it means now, it puts additional pressure. We have to spend more as South Africa adjusts its prices, and especially industry-wise, we're gonna see most of the industry in SA adjusting price related to, expenses related to their products, and the net effect is an increase in the price of their products. And as a key consumer of SA's products against a dip in our own industry, I think we are likely to feel the impact. If you had to go back a few years back, why Zimbabwe enjoyed a deflation within the period around 2013 to 14 thereabout, it was because regional currencies were weaker against our currency of adoption, which was the US dollar then, and we tended to see deflation in play. And given that SA, which was our biggest trading partner, was suffering from that deflation as mineral prices became weaker against, in global markets, it also meant a lot of deflationary pressure coming through to Zim. So we're gonna see a reverse effect now. We're gonna see inflation rising on the back of rise in the price of commodities. In the rise of SA's own prices. But if you're looking at a global scale, fundamentals within the crude oil market have not been looking good. Of course, we have seen supply being constrained lately as OPEC members decided and agreed to reduce the supply on the market. But very soon we might see Russia pulling off from that agreement, and the US as well is planning to ramp up more of its produce as well. So it leaves out Saudi Arabia and some of the other key guys to try to play a catch up, but then that would result in excessive supply of the commodity, and that would weaken the price, and it would reverse the order in terms of the net imported price for that product when it lay either in South Africa or in Beira. So the fundamentals internationally are looking in the positive side. But
I think you just touched on an interesting subject there, the subject of fuel prices. Already we're struggling with our own fuel. We have actually increased our fuel prices just recently, and there was actually pandemonium when that transpired. What could we expect to see in as far as our fuel market is concerned? Because already the fuel queues are back, and there's a bit of chaos in that regard. Would you want to explain what the ramifications of that are?
I think going forward, what's going to determine stability in our own market is not mainly to do with how the global market is playing out. If you see that increase, it wasn't coming from a point where the international prices had gone up. the increase in local prices was a monetary related issue. It was to do with our own domestic issues. So it had less to do with what's happening on the global market. That's an increase of about 150% in terms of price. So I don't really see the interplay on the global market, shaping our own dynamics. I believe that our own dynamics are going to be shaped by the stability of our own currency, because with a partially liberalized exchange rate, what it means is that the price of fuel or the price of any commodity which is imported have to track the exchange rate as well, because you have to dispose of your local money and buy forex in order for you to import. So it's like the fuel is likely to track the matrix around the interbank market, as well as our own fundamentals, because the interbank market is a reflection of the fundamentals in our economy. If we are going to see a weakening a weakening balance of payment position, it means we are a net exporter. We're a net importer, and it means we are losing forex. So it means our demand for forex is likely to be higher than the supply. If we also have got a weaker fiscal position, fiscal balance position, that will also mean we'll have to borrow more, and we have possibly, if we use the open market operations, it means we are likely to push money supply up, and there's gonna be a worse off disequilibrium in the market. So I think what's gonna shape our own market is our domestic fundamentals, ahead of any other outside influence.
Okay, but given the fact that we're depending on imports, we've got statutory instrument 122 which actually put a stop on imports being lifted, and with actually our levels of production in the economy being very much at a minimum. Does this mean in terms of our inflation? I mean, the finance minister has said that we could actually expect a decline or a containment of our inflation.
Yeah,
Is that feasible?
Again, that's a technical. There's a technical consideration. Inflation is likely to come down based on if you look at the best effect of the CPI. We are coming from an October jump, which put us at a certain higher CPI, and now as we near towards the same month, that's in 12 months. That's in 12 months from that level in the prior year. It means it moderates out the inflationary impact, but the general price level will relatively be higher. In fact, will be higher than what we are normally used to. So inflation is the continual rise. So we might rise and get to a certain point and stabilize at that point, which is a high point, but it might not be a sustained increase from that. I think going forward, price stability would also feed from the interbank, as long as there's definitely a huge import component of our goods and services in the economy. So there's gonna be a fraction that's dependent on our import bill. So it's most likely that inflation is gonna it might stabilize based on the best effect, but our fundamentals may not be as strong to support stability in that regard.
Well, thank you. Insights. We're going to take a break. Please stay tuned. the stories that we did report on at length. On to KEBS now. Respect KEBS recorded losses of $19 million in Efis 9 readjustments. Would you want to shed a bit more light on the significance of that?
Yeah, this is mainly out of the adoption of the newest financial reporting standard, which is Efis 9, adopted in 2018. So I think it's basically to do with classification and adjustment of the net impact of such an accounting standard. So I don't think there's much to elaborate on that, but just to say all the companies, notably banks, are likely to incur related to that, and a lot of banks though have not been growing much in terms of their loan book, because if you look at the impact in terms of treasury bills, it has been less severe, because I saw there's a reclassification which puts treasury bills at a higher level, and there's then the net impact of a readjustment, which then again shaves off a bit. And when you look at the net impact on treasury bills of adoption of this standard, it's less significant, and most banks, as you can see, they've been growing their treasury bills portfolio at a much faster rate than they were growing loans. But for KEBS, this is a mortgage-based bank, and they haven't been too quick in terms of their approach, their lending approach against other banks. If you look at other banks over a three-year period, you would find that there's been less growth in terms of loans. And for KEBS, I think that's why they were more of a casualty. They also suffered from the adoption of that reporting standard.
Okay, then moving on to Brainworks, they gave us what seems to be a prelude into the financials for the year ended 31 December 2018. They've got their main assets being Dawn Properties as well as Africa Sun, and against the background of the PAAB pronouncements as well as the monetary policy pronouncements, that is of course cascaded down to their inability to actually publish results within the stipulated JSE timeframe. But that's of course something that we're actually more conversant with. It's been the order of the day down here. Sure. But I wanted to talk about the prelude into the details, particularly where Dawn Properties is concerned, how they've actually recorded a growth in terms of their revenue from the disposal of some of their stands. How important is that, considering the fact that they heavily invested in the field, in the properties business, and they're actually making progress in that regard?
There's been a realization in the property sector, and seem to say there are opportunities in all aspects of the property sector, be it in residential properties, be it in hospitality properties, be it in suburban offices. And if you look at the portfolio, Dawn's own portfolio, it's predominantly a hospitality property portfolio. I mean, 90% of their portfolio is in hotel property. So it's been a way of diversifying. They're getting into residential. There's a huge backlog which sits at about 1.4 in terms of residential property in Zimbabwe. And so most people have been getting into the development of stands, and some even into the construction of residential properties. And that's the space where Dawn thought it's a low-hanging fruit, and then they went into it, and they're starting to reap results of diversifying. But I think there's also an important matrix around how the property market is shaping up. If you look at KEBS, under Old Mutual, in fact, the Old Mutual property side of the business, they have been trying to diversify their portfolio. It's predominantly a commercial property, CBD offices, and they've been looking for trying to find opportunities in other areas. But significantly, I mean, most importantly, there has been a decline in the allure of CBD offices across the market. I think this is true of every player who has been playing in that market. One key player in that space, that's Mashonaland Holdings. Recently, they converted a key CBD, a key
House.
CBD property into a hotel. Why? There's been booming fortunes from the hospitality sector, and in fact the outlook is looking even more favorable to justify a movement or a diversification towards that. If you look at ZPI, the same thing. They disposed of Zimbabwe Center in Harare, and they put that money in Sawanga, which is concentrated in the resort town of Victoria Falls. Old Mutual is moving into Victoria Falls, strategic positioning, against the tourism sector. And so for this group, for Dawn, they've been positioned, they're predominantly into that space, and they're looking at even getting into more different or diverse sectors just to maximize shareholder value.
Okay, and twinning that would also be the counterpart corporation in that regard. Of course, that's African Sun, which was also recorded a growth of 7% in terms of occupancy levels to 59%, which is not something that it actually enjoyed recently. So, would you also want to shed more light where perhaps that is concerned as well?
Yeah, the performance of these two is quite related. Why? Because African Sun pays Dawn against the level of business over which it generates. If it generates good business in terms of hospitality management services, then they pay a certain rate to Dawn. So whenever the fortunes of African Sun goes up, then the fortunes of Dawn also goes up, and consequently the group, being the Brainworks side. So African Sun benefited from a boom in tourism, but specifically in 2018 there were elections in Zimbabwe, and all hotels were booked within obviously the prime areas, be it Harare and whatnot. And some of those who came through also find time to go to resort towns, be it Vic Falls and Masvingo, and that's before the August 1 disturbances. But before that, we really saw a good number of tourists coming in, a good number of business people coming to prospect in terms of opportunities that are in Zimbabwe, and obviously that was good business. I remember an engagement with African Sun earlier in the year highlighting how all their rooms have been taken up, and how they were even failing to provide for space in Victoria Falls. So basically these two's performance is related, and it's anchored on tourism.
All right, Dan, key respect for the insights. Thank you viewers for staying with us. Please stay tuned as we bring you up next is stock markets.
Welcome back, viewers. I'm joined by Anisu for the stock markets daily dose. Anisu, good day.
How are you doing? Respect, how are you doing today?
I'm doing just great. Let's kick into the daily dose. Let's look at the ZSE's performance today.
All right, just before we go deep into what happened today, we did realize that at the end of last week there was a snap in the 4-week run of losses for the stock market to come up, mainly because of a top 10 index push, which had come up almost 1.14%, which is almost similar to what happened today. It seems as if a lot of pressure that has been put on the exchange rate is causing a flock back. Could you say that? Or is it a little bit too early? But then before we delve into that, today the offshore index 0.8%, while the industrial index also went up 0.81% for that index to settle at 408.85 points, while the offshore index settled at 122.63 points. This pretty much shaved their year-to-date losses to about 16.12% and 16.06% on a year-to-date basis. Mining's index is pretty much stable for the second session running. Top 10 index, as I mentioned earlier on, has been pushing the stock market up for the last 2 sessions now, coming up 1.14%. Probably cassava today has a huge influence, coming up 6.22%.
Yeah, I think I agree in terms of some of the dynamics around the market. It's been a 4-week dip and then a recovery in 1 week, and against that we are seeing also a convergence in price in terms of, in fact we're seeing a further fall in the local exchange rate. I mean, against the US dollar, and I believe there's been an improvement in liquidity on the interbank rate based on the movement in terms of price, but we are yet to really see the figures in terms of what flows are being generated there. But clearly the market is still looking for direction. It's too early for us to really conclude that investors are coming back, but if the top 10 counters are moving in a positive direction on a generalized note, then it might mean that investors are coming back after a sell-off.
It's been a strong 3 days for Old Mutual. Actually, it's improving that much. Evidently, like we mentioned earlier on, that on a week basis, our stock market is up, consequent to a 2.14% positive change there for the top 10 index, settling at 115.92, like we mentioned earlier on, while the all share is up 1.46%.
Let's now get to the movers of the session.
Okay. For our risers and fallers today, cassava was the best performing counter, coming up 6.22%, while on the other end of the stick, Econet, its parent, actually shed off about 2.83%, making it the weakest performer of the session today. Will Day did trail cassava, coming up 6%, while Old Mutual added about 2.19% for it to set at 815.29 since they did release their financial results last week Friday.
It's actually the parent company.
Oh yes, that's the parent company, sorry about that. And then Zimbabwe is up 1.23%, while FBC is up 0.74%.
And getting to the forex market,
well, the forex market seems to keep on weakening in relation to the US dollar. As you can see that the interbank rate has to about 3.02 points thereabouts, which is pretty much almost close to about 20% decline in terms of its power, coming from a 2.5 level that was promulgated and just after the MPS announcement. Your Old Mutual implied rate did come up to about 4.36%, pretty much because of how we strengthened today on the local market, and the the parallel market has also kept its margin of safety there, coming up to about 4.128 today.
Quite interesting. And what is your outlook in terms of the forex market? The governor actually predicts that the price is due to come off. What is your prediction in capping?
Well, recently I didn't hear that they have reversed their statement in terms of whether they were going to be paying.
They actually said we were misquoted by the press, or we were misquoted by whoever it is that they think misquoted them. But I believe government has a tendency to play games with the public, and it might be that they actually said it wanting to check sentiment, and then they realize maybe
it's the wrong move.
It's a wrong move, and they retrace. And actually, there's been a lot of speculation, some even alleging that maybe the run on the black market lately is inspired by, government probably playing a hand so that they could pay farmers. I don't know why these things keep on coming. I don't know what government can do to increase perception or even transparency. I believe it's important for government to push out information to let people know the real money.
I think they're not very confident about their current position, because if they keep on playing such mind games with the nation, trying to see how things may go if we don't pay our tobacco farmers, or if they pay, and then rumors coming up that they will they've been playing a hand in the foreign exchange market. It shows that somewhat, to an extent, I'd like to think that they have no real direction or really have a set foot as to what they really want to achieve with how they're going to be playing around with their interbank rate. It could be something a little bit harsh for my own sentiments, but they don't show a lot of direction. They're not even giving us much detail as to how the interbank rate has been performing. We don't know as to what kind of volumes have been trading on a day basis for us to really know how the willing buyer, willing seller trend is working out there.
Anyway, thank you, Anderson.
All right.
Thank you, viewers. Join us tomorrow for the same segment.
Don't